In 1873, the US government quietly removed silver from the monetary system in what historians call the crime of 73. In 1965, they physically stripped silver from your dimes and quarters overnight. Both times, silver vanished from ordinary circulation and went straight into government and industrial hands. Now it's happening again, but this time it's permanent. For 5 straight years, from 2021 through 2025, the world has burned through 800 million ounces more silver than mines could produce. That's nearly an entire year of global mining output gone. Meanwhile, industrial demand has exploded 51% since 2016 as solar panels and electronics devour every available ounce. And here's what should terrify you. In 2025, the US government officially classified silver as a critical mineral, meaning they now compete directly against ordinary citizens for the remaining supply. When the math breaks in 2026, the last physical silver goes to governments and defense contractors, not to retirees walking into coin shops with cash. Silver served as the backbone of American money for nearly a century, circulating freely in the pockets of ordinary citizens as legal tender that held intrinsic value beyond government promises. The United States operated under a bimetallic standard throughout the 1800s, where both gold and silver coins moved through commerce as genuine money, not mere tokens representing debt. Silver dollars, half dollars, quarters, and dimes contained 90% pure silver, making each coin a tangible store of wealth that citizens could hold, trade, and trust regardless of political upheavals or banking crises. This system granted monetary independence to working Americans, farmers, and small business owners who understood that real money could not be printed into existence by political decree. The first deliberate removal of silver from American hands occurred through the Coinage Act of 1873, legislation so deceptive that contemporaries branded it the crime of 73. This act quietly eliminated the free coinage of silver, effectively demonetizing the metal and forcing the United States onto a gold standard without public debate or acknowledgement. The law passed through Congress with minimal discussion, buried within technical language about mint operations and coin specifications that concealed its revolutionary impact on the monetary system. By ending silver's monetary role, the legislation concentrated monetary control in fewer hands while eliminating the metal that had provided working Americans with accessible, tangible wealth storage. The consequences rippled through society as silver's removal from the monetary system transferred enormous purchasing power from citizens to banking interests who controlled gold supplies and credit creation. Farmers and labourers who had relied on silver coins as both medium of exchange and wealth preservation found themselves dependent on a monetary system increasingly dominated by financial institutions rather than physical assets they could personally hold and verify. Nearly a century later, the government executed an even more brazen silver confiscation through the Coinage Act of 1965, which stripped silver from dimes and quarters entirely while reducing half dollars from 90% silver to 40%. This legislation represented the complete severance of everyday American currency from precious metals, replacing constitutional money with base metal tokens backed only by government promises. The timing was deliberate, occurring as silver's market value approached its artificially suppressed face value in coins, creating arbitrage opportunities that would have drained the Treasury's silver reserves through citizen hoarding and melting. The final blow came in 1968, when the government terminated silver certificate redemption, breaking the last legal link between paper currency and physical silver. Citizens who had held silver certificates under the assumption they could exchange them for actual metal discovered their claims had been quietly dissolved, leaving them with irredeemable paper promises. This action completed the transformation of American currency from silver-backed money to pure fiat currency, eliminating citizen access to government silver stocks while maintaining the illusion of monetary continuity. These historical precedents reveal a consistent pattern where governments remove precious metals from public circulation through legal manipulation rather than market forces. When silver becomes undervalued by official pricing relative to its market worth, citizens naturally respond by hoarding and melting coins, recognizing the arbitrage opportunity. Rather than allowing market prices to correct this imbalance, authorities simply change the composition of money itself, keeping the metal for institutional use, while providing citizens with substitute tokens of diminished intrinsic value. The mechanism operates through deliberate price suppression, followed by supply restriction, creating artificial scarcity that benefits large institutional holders while impoverishing ordinary savers. Understanding this historical pattern becomes crucial for recognizing similar dynamics in contemporary precious metals markets, where familiar forces appear to be orchestrating another systematic removal of silver from public access through structural deficits, strategic classifications, and policy manipulations that mirror past confiscations. The 1990s created a dangerous illusion of silver abundance that masked the systematic depletion of strategic reserves accumulated over decades of government stockpiling. Following the Hunt brothers' price explosion of 1979 to 1980, silver entered a prolonged price suppression period that lasted nearly 2 decades, conditioning markets to view the metal as plentiful and economically insignificant. This extended price decline was not the result of genuine oversupply, but rather the calculated liquidation of massive government and institutional stockpiles that had been accumulated during earlier periods of strategic mineral acquisition. During the 1980s and 1990s, global mine production expanded significantly as new deposits came online and improved extraction technologies increased output from existing operations. Large polymetallic mines in South America, Mexico, and other regions dramatically boosted silver production as a byproduct of copper, lead, and zinc mining operations. However, this increased mine supply coincided with aggressive government stockpile liquidation that flooded markets with metal that had been held in strategic reserves for decades, creating artificial abundance that suppressed price signals and encouraged massive industrial consumption. Research indicates that governments and central banks dumped approximately 617 million ounces of silver between 1999 and 2006, followed by an additional 157 million ounces between 2007 and 2013. These enormous quantities represented decades of accumulated strategic reserves being liquidated to supplement mine supply and maintain artificially low prices for industrial users. The United States National Strategic Silver Stockpile, which had contained hundreds of millions of ounces accumulated during wartime and Cold War periods, was systematically drawn down until essentially depleted by the early 2000s. The timing and scale of these government sales was no coincidence, but rather a coordinated effort to prevent silver price increases that would have signaled genuine scarcity and encouraged hoarding behavior among private investors. By releasing strategic reserves gradually over more than a decade, authorities maintained market stability while quietly transferring accumulated national wealth to industrial consumers at artificially suppressed prices. This massive stockpile liquidation effectively subsidized industrial silver consumption while depleting reserves that had taken generations to accumulate. Simultaneously, multiple United States government agencies that had published detailed silver inventory data for decades suddenly ceased transparent reporting in the mid-1990s, creating an information blackout precisely when strategic stockpiles were being liquidated. This data suppression followed a consistent pattern, where transparency decreases as strategic materials become genuinely scarce, preventing public awareness of inventory depletion until reserves approach critical levels. The economic structure of this period reveals that the 1990s and early 2000s were not characterized by genuine silver surplus, but rather by a carefully orchestrated combination of increased mine output, aggressive government stockpile sales, and enhanced recycling efforts that temporarily covered a growing structural deficit between fabrication demand and sustainable mine supply. Rising industrial demand for electronics, photography, and other applications was consuming silver faster than mines could sustainably produce it. But this imbalance remained hidden behind the liquidation of decades' worth of accumulated strategic reserves. This systematic stockpile depletion represented the spending down of a strategic cushion that previous generations had accumulated through disciplined resource acquisition policies. The low silver prices of this era were not market signals of abundance, but rather the artificial result of dumping previously accumulated national wealth to maintain industrial supply chains and prevent price discovery mechanisms from operating normally. Understanding this historical precedent becomes crucial for recognizing how strategic material shortages are masked through inventory liquidation until reserves approach exhaustion, at which point market dynamics shift dramatically as the cushion disappears and genuine scarcity emerges in physical markets. The period from 2021 through 2025 marks an unprecedented era of structural silver deficits that has systematically consumed the remaining cushion of above-ground inventories accumulated over previous decades. A market deficit occurs when total annual demand from industrial applications, jewelry manufacturing, and investment purchases exceeds the combined supply from mine production and recycling, forcing the market to draw down existing stockpiles to meet consumption requirements. This represents a fundamental shift from the equilibrium that characterized earlier periods when government stockpile liquidations and expanded mine output could satisfy growing demand without depleting accumulated reserves. Data from multiple industry sources confirms that the silver market has operated in deficit for 5 consecutive years, with the cumulative shortfall approaching 800 million ounces by the end of 2025. This enormous deficit represents nearly an entire year of global mine production that has been extracted from above-ground inventories, systematically draining the strategic reserves and investment stocks that had provided market stability during previous periods of supply disruption. The 2024 deficit alone reached approximately 150 million ounces, while forecasts for 2025 indicate continued shortfalls exceeding 100 million ounces despite higher prices that should theoretically encourage conservation and supply increases. The primary driver of this structural imbalance stems from explosive industrial demand growth that has fundamentally altered silver consumption patterns over the past decade. Electronics and electrical applications have increased their silver consumption by 51% since 2016, driven by expanding smartphone production, electric vehicle manufacturing, and the proliferation of electronic devices requiring silver's unique conductive properties. Solar photovoltaic demand has experienced even more dramatic growth, expanding from approximately 5.6% of total silver demand in 2015 to 17% by 2024, making renewable energy infrastructure a dominant force in silver consumption as governments worldwide pursue decarbonization policies. Supply constraints have simultaneously limited the market's ability to respond to this demand explosion through increased production. Global mine output has stagnated or declined from its mid-2010s peak, with 2025 production projected at 7% below 2016 levels, despite significantly higher silver prices that should incentivize expanded mining operations. The fundamental constraint lies in silver's role as a byproduct metal, with 70 to 80% of global silver production coming from copper, lead, zinc, and gold mining operations, where silver extraction depends on the economics of primary metals rather than silver prices themselves. This supply inelasticity means that even substantial silver price increases cannot quickly generate proportional production increases, as mining companies make development decisions based primarily on copper, gold, and other primary metal economics rather than byproduct silver values. New mining projects require 7 to 10 years from discovery to production, while declining ore grades and increasingly stringent environmental regulations further constrain the industry's ability to respond rapidly to market signals. The strategic implications of this deficit became officially recognized in 2025, when the United States government formally classified silver as a critical mineral, acknowledging supply risks and the metal's importance to energy transition and defense sector applications. This designation creates federal incentives for domestic stockpiling, fast-track permitting for mining projects, and implicit acknowledgement that government demand now competes directly with private citizens for available supply. The critical mineral classification represents a fundamental shift in silver's strategic status, transforming it from a freely traded commodity to a resource requiring government oversight and potential supply allocation. These structural deficits operate insidiously by quietly draining inventories rather than causing immediate price explosions, creating the illusion of market stability, while systematically consuming the remaining float of available metal until scarcity becomes undeniable and irreversible. Understanding the mechanics of silver distribution reveals a critical distinction between total above-ground silver stocks and the much smaller quantity of freely tradable metal that actually moves between institutional vaults and retail markets. Industry analyses estimate approximately 1.6 million tons, or 51 billion ounces of silver, exists above ground in various forms, a figure that dramatically exceeds the 90,000-ton identifiable inventories commonly cited in market reports. However, this vast quantity includes deep storage forms, such as electronics components, photographic materials, silverware, and industrial applications, where silver recovery remains economically prohibitive at virtually any price level. The genuinely liquid investment forms that constitute the true tradable float include bullion bars, investment coins, exchange-traded fund inventories, and exchange warehouse stocks that can move quickly between institutional and retail markets based on supply and demand dynamics. This freely tradable silver represents only a fraction of total above-ground stocks, creating a much tighter supply situation than aggregate inventory figures suggest. When structural deficits consume this liquid float, the impact on accessible silver becomes far more severe than total inventory calculations would indicate. Evidence of this shrinking float has become increasingly visible through declining London vault stocks and exchange-traded fund holdings, which have dropped approximately 170 million ounces from their 2021 peaks, according to industry tracking services. This inventory decline coincides with record high lease rates and documented liquidity squeezes in wholesale markets, classic indicators of tightening physical availability despite stable headline mine production figures. The divergence between apparent abundance in total inventory statistics and genuine scarcity in tradable stocks creates market distortions that become increasingly pronounced as deficits persist. The paper derivatives market systematically obscures this physical scarcity by creating an illusion of limitless supply through massive futures, trading volumes that dwarf actual metal availability. On individual trading days, exchanges have processed silver futures contracts representing 779 million ounces, nearly equivalent to an entire year of global mine production, traded purely as paper instruments with minimal connection to physical metal. These enormous paper volumes allow price discovery mechanisms to operate as though abundant silver exists when physical inventories are actually contracting rapidly. The COVID period of 2020 to 2021 provided a preview of how physical silver disappears from public access, even when paper markets continue functioning normally. During this crisis, the United States Mint temporarily suspended American Silver Eagle production due to unprecedented demand that increased 300% month over month, while major dealers exhausted inventories and many ceased sales operations entirely. The disconnect between paper and physical markets became stark as futures contracts traded near $12 per ounce, while retail customers could not purchase physical silver anywhere near that price due to exploded premiums and widespread unavailability. This distribution mechanism reveals that silver disappearance begins not at mines or industrial facilities, but at the retail level, where individual citizens attempt to convert currency into physical metal. As structural deficits persist and institutional inventories decline, dealers increasingly depend on investor selling and wholesale stockpiles to maintain retail supply. Once these sources are exhausted, coin shops and online dealers simply run out of inventory, even while exchange prices continue to suggest adequate supply exists. The retail shortages represent the final stage of a systematic inventory depletion process that begins with government stockpile liquidation, progresses through institutional vault drawdowns, and culminates in the inability of ordinary citizens to access physical silver at posted prices. Understanding this sequence becomes crucial for recognizing that silver unavailability at the consumer level signals the completion of a larger process of strategic material concentration that has been operating systematically for years before becoming visible in retail markets. The convergence of accumulated structural deficits and depleted inventories creates a mathematical inevitability that transforms 2026 into the year when silver effectively disappears from public circulation and enters an era of strategic allocation controlled by institutional and governmental forces. The arithmetic is straightforward. Identifiable above-ground investment inventories total approximately 90,000 tons, while the cumulative structural deficit from 2021 through 2025 approaches 800 million ounces or 25,000 tons, representing nearly a full year of global mine production extracted from available stockpiles. When combined with ongoing forecast deficits exceeding 100 million ounces annually and the complete exhaustion of government sales that once supplemented market supply, the remaining freely tradable silver approaches levels insufficient to meet competing demands from industrial users, investors, and newly empowered governmental claimants. The emergence of nation-states as direct competitors for silver supplies fundamentally alters market dynamics by introducing actors with unlimited currency creation capabilities and strategic imperatives that transcend economic considerations. Silver's addition to the United States Critical Minerals List in 2025 provides federal agencies with explicit authority to secure domestic mine supply, build strategic stockpiles, and implement trade restrictions on silver-bearing products to protect national interests. This governmental participation transforms silver from a freely traded commodity subject to market forces into a strategically controlled resource where allocation decisions reflect political and military priorities rather than purchasing power alone. International competition intensifies these dynamics as major solar manufacturing nations and industrial centers face identical incentives to secure long-term silver access through bilateral agreements, mining investment, and stockpile accumulation that removes metal from global markets. The result creates a multi-front competition where governments with currency printing capabilities systematically outbid private citizens for available supplies while simultaneously restricting export flows to protect domestic industries. Supply expansion cannot resolve this imbalance due to silver's fundamental role as a byproduct metal, where 70 to 80% of production depends on copper, lead, zinc, and gold mining economics rather than silver prices themselves. Even dramatic silver price increases cannot generate proportional production responses, since mining companies make development decisions based on primary metal economics, while silver extraction remains secondary. New mining projects require 7 to 10 years from discovery to production, while declining ore grades and environmental constraints further limit industry responsiveness to price signals. The practical manifestation of silver's disappearance from circulation begins at retail levels, where coin shops and online dealers post permanent out-of-stock notifications or implement strict rationing systems with prices significantly above official spot quotations. A parallel informal market develops where physical silver trades at multiples of quoted prices through private transactions between individuals who recognize that official markets no longer provide actual metal access. Institutional markets experience similar disruptions as mints suspend or severely limit bullion coin programs, while exchanges increasingly settle contracts in cash rather than physical delivery due to inventory constraints. Policy implementation accelerates this transition as governments prioritize industrial and defense applications through tax penalties, reporting requirements, and supply allocation systems that effectively discourage retail bullion ownership. The historical pattern reaches completion as silver follows the same trajectory as previous monetary metals. First redefined to eliminate monetary constraints, then liquidated from strategic reserves at artificial prices, then consumed through structural deficits, while derivatives mask scarcity, and finally reclassified as critical materials requiring governmental control and allocation. This systematic process reveals that 2026 represents not an unexpected crisis, but the predictable culmination of decades of policy decisions designed to transfer precious metals from individual ownership to institutional control through market mechanisms that maintain the appearance of voluntary exchange, while ensuring predetermined outcomes favorable to large-scale industrial and governmental users.